You're not poorer because you did something wrong. You're poorer because the yardstick has been bent. Stop for a second and think very carefully. If you look at the official numbers, everything should be fine. The stock market keeps setting new highs. GDP is still growing. Unemployment is low. Experts on television say the economy is solid. But then you open your bank account. You see the money is still there, but the feeling of safety isn't. Your salary may go up, but every time you go to the grocery store, you can buy less than before. Your savings may earn interest, but the dream of buying a home keeps drifting farther out of reach. You're not spending more recklessly, yet by the end of the month you find yourself calculating more than you used to. And then a question begins to form, quietly, but intensely uncomfortable. If everything is getting better, why do I feel like I'm falling behind? This isn't just your feeling. Millions of people are going through the same thing, even if they don't say it out loud. The problem isn't that you invested wrong, and it's not exactly that you haven't worked hard enough. The problem lies much deeper, in the way the value of money is being changed, little by little, very quietly. Because there is a hard truth to accept. You may be up on paper, but losing real value in everyday life. You may see your portfolio rising, but the purchasing power of the money in your hand is being drained away like water running through an invisible crack. And what is the most dangerous part? Not a loud crisis, not a market crash in a single day, but when the system is still functioning, while the value of money is no longer standing still the way you think it is. In the next part, we are going to do something very important. No arguing over emotions, no listening to slogans. We are going to look straight at a simple but deeply uncomfortable question. Are we measuring our wealth and poverty with a yardstick that has already been bent? If that question makes you feel uneasy, good, because that is exactly where we need to begin. And before we move on to the next part, don't forget to hit the subscribe button so you can stay with us all the way to the end of this video. We are measuring wealth with a yardstick that is no longer fixed. Let's do a very simple thought experiment. Suppose last year your investment portfolio rose 15%. Your bank sends a congratulatory notification. The press calls it a successful year. But the real question is not whether you have more money, but does that money buy more or less than it did before? This is the point that many people, even long-time investors, often overlook. In finance, there is an extremely important distinction, yet it is rarely mentioned in mainstream media: nominal returns and real returns. Nominal return is the number you see on the screen. Real return is what that money can actually buy in everyday life. These two concepts are not the same, and in certain periods of monetary history, they can move in opposite directions. When a currency is stable, the difference is not too large. But when the value of money begins to slip, every measurement based on it is pulled off course as well. Think about this. If you measure height with a rubber ruler and each day it shrinks a little, then even if you stand still, the measured number will still rise. You are not taller. Only the ruler has changed. Money is the same. When a currency loses value, asset prices quoted in that currency tend to rise, not because the assets are better, but because the unit of measurement has weakened. That is why, in many periods of history, people have witnessed a paradox that is very hard to understand. Asset markets surge, but the standard of living for most people does not improve. It may even feel more insecure. Not because people don't understand economics, but because they are being asked to assess their wealth using a unit that is no longer neutral. And here is the key point. When the value of money is no longer stable, profit is no longer an absolute number, but becomes a relative concept. You can be up on your statements, but if the money in your hand buys less, then that wealth exists only on paper. This is not a flaw of the market, nor is it the result of an individual investment decision. It is the inevitable consequence when a monetary system enters a new phase, a phase in which the unit used to measure value begins to drift away from its neutral role. And to understand why this is happening, we need to step away from personal feelings and look directly at the structure of today's financial system. In the next part, we will do exactly that. We will talk about debt, not your debt, but the debt of the entire system, and why, when debt goes too far, the value of money is always the first thing sacrificed. The system doesn't collapse, it erodes from the inside. To understand why money begins to lose value, we need to talk about debt. Not your credit card debt, not your mortgage, but the debt of the entire system. In financial history, every modern economy passes through a familiar cycle. a cycle that is not loud, not dramatic, but extremely unforgiving. That cycle usually unfolds in three stages. Stage 1. Borrowing to grow. Debt is used to invest, expand production, and raise productivity. The economy develops, incomes rise, and debt can be repaid with relative ease. Stage 2. Borrowing to sustain. Growth begins to slow. New debt no longer creates as much value as before, but it is still necessary to keep the system running smoothly. And then comes the final stage, borrowing to service old debt. At this stage, debt is no longer a tool for creating the future. It becomes the burden of the past. The system is still functioning. The numbers are still rising, but the real energy has begun to drain away. The danger of this stage lies here. Debt grows faster than the ability to generate real value. When that happens, every policy option becomes difficult. You can raise taxes, but when taxes rise too far, capital finds a way to leave. Businesses relocate. The wealthy change their place of residence. The tax base shrinks instead of expanding. You can cut spending, but cut where? Social welfare? Healthcare? Education? Defense? Every option touches powerful interest groups and carries the risk of political and social instability. In the end, one path remains, the one that meets the least resistance in the short term, lightening the debt burden by lightening the value of money. This is not a conspiracy. It is a mechanism. When money loses value, debts denominated in that money lose value as well. Borrowers benefit. Those who hold cash and nominal assets bear the cost. The problem is that this mechanism does not happen overnight. It unfolds very slowly, very steadily, and quietly enough that most people do not notice it right away. You don't wake up one day and see your money disappear. You simply realize that with the same amount of money, you have to pay more for the same life. And when this goes on long enough, it creates a dangerous illusion. Everything seems fine because no collapse has occurred. But in reality, the system does not need to collapse to cause damage. All it needs is for money to lose value steadily over time. That is how many debt cycles in history have ended. Not with an explosion, but with the continuous erosion of purchasing power. And when a system enters this phase, one important question must be asked. What are the people at the center of the system, the ones who understand it best, doing to protect themselves? In the next part, we will not look at what they say. We will look at what they do. More specifically, the behavior of the very institutions that have the power to create money. When the money printers no longer trust money, there is a very simple principle in finance. Don't listen to what people say. Watch what they do with their money. If the debt cycle is entering its final stage, if the value of money must be gradually lightened over time, then who understands this most clearly? Not individual investors, not workers, but central banks, the institutions with ultimate power over the creation of money. And here is the thought-provoking part. While they continue to expand their balance sheets, continue injecting liquidity into the system, continue issuing more debt, they do not hold money in the way the public typically assumes. Instead, over the past several years, central banks around the world have quietly changed the structure of their reserves. They have gradually reduced the share of assets that depend on third-party promises. They have gradually increased the share of assets that require no one's guarantee. This is where we must address a core concept that is often overlooked: counterparty risk. When you hold bank deposits, you trust the bank. Government bonds, you trust the issuing government. Corporate bonds, you trust that company's ability to repay. Stocks, you trust the entire accounting, legal, and governance system. Every financial asset is a promise, and that promise only has value as long as the system behind it remains stable enough to be trusted. But when systemic risk rises, when debt piles up, when global financial relationships become more strained, one type of asset begins to regain priority: assets with no counterparty risk. Not because they offer the highest returns, not because they are fashionable, but because they do not depend on anyone's commitment. In recent years, data shows that central banks have been accumulating large quantities of such assets at the fastest pace in many decades. What matters is not the absolute number. What matters is the trend. When the very institutions that create money choose to hold part of their reserves in a form that cannot be printed, that sends a very clear signal. Not that money will disappear, not that the system is about to collapse, but that trust is no longer placed entirely in a single unit of measurement. And when trust begins to fragment, large flows of capital do not wait for a crisis to erupt. They move first, quietly, strategically. But one big question remains unanswered. Why has this trend accelerated so sharply in recent years, and why is it no longer just a defensive choice, but increasingly a systemic response? To answer that, we need to look at a deeper shift, a change in how money and finance are being used as instruments of power. In the next part, we will talk about a concept rarely discussed in mainstream media, yet one that is reshaping the entire global financial order: capital wars. When capital is no longer neutral and trust becomes the scarcest asset of all. Capital wars, when money is no longer neutral. For decades, we have lived with an implicit assumption: money is neutral. The financial system is infrastructure. Capital flows according to economic logic. But that assumption is no longer valid. The world has entered a new phase, one in which money is not merely a medium of exchange, but a lever of power. At first, countries competed through goods, tariffs, quotas, supply chains. That was trade wars. But when trade no longer provides sufficient leverage, the game shifts to another level: capital wars, the battle for control over capital flows. In capital wars, the targets are not factories or shipping containers. The targets are access to finance. Who gets to hold reserves, where settle payments, through which systems, borrow in which currency, and access global capital markets at all? A country may still possess resources, people, and productive capacity, but if it is cut off from the financial system, everything instantly becomes fragile. The turning point of this phase did not come from a speech. It came from action. When the reserve assets of a sovereign nation can be frozen by a single political decision, the message sent to the rest of the world is unmistakably clear: money within the international system is no longer an absolutely neutral asset. From that moment on, the way countries view foreign exchange reserves has changed. The question is no longer, how much yield does it offer? But rather, if political relationships change, will this asset still belong to me? This is an extremely dangerous question for any monetary system, because money, ultimately, exists on trust. And when trust becomes conditional on geopolitics, it is no longer pure trust. The response to this is not panic. The response is defense. Countries begin to diversify reserves, reduce dependence on a single currency, build parallel payment systems, promote bilateral trade in local currencies, not because they want to overthrow the existing order overnight, but because they do not want to be placed in a vulnerable position when that order is used as a tool of pressure. What must be emphasized here is this: this is not the collapse of a specific currency. This is the fragmentation of global trust. In such a fragmented world, large capital flows no longer seek the highest yield first. They seek control, neutrality, and the ability to survive across multiple political scenarios. That is why the trend discussed in the previous section is not only continuing, but accelerating. Because once money becomes an instrument of power, monetary risk becomes geopolitical risk. And when the nature of risk changes, risk management must change with it. This brings us to the final question, and perhaps the most important one for each individual. In a world where money is no longer neutral, where should you position yourself so that you are not swept into conflicts you cannot control? In the next part, we will step away from the national and systemic perspective and return to the real-world impact on individuals, not through investment advice, but through how to think about managing monetary risk in everyday life. No panic, but no indifference either after everything we have just gone through. The most important thing that needs to be said is this: you do not need to panic. But you also cannot stand still as if everything were still normal. Because the greatest risk in the current phase does not lie in choosing the wrong investment, but in placing your entire financial future on a single assumption. The assumption that the currency you use today will retain its value over the long term, the financial system will always be neutral, what worked in the past will continue to work in the future. For most of the time, these assumptions hold well enough that no one feels the need to question them. But during transitional periods in monetary history, those very familiar assumptions become blind spots. This does not require you to pick sides, nor does it require you to become a financial expert. It only requires a very fundamental shift in thinking, separating investing for growth from managing monetary risk. These are not the same thing. You can have a solid investment portfolio, but if that entire portfolio depends on a single currency unit, you are still carrying a systemic risk that many people fail to recognize. Diversifying a portfolio does not mean diversifying monetary risk. Owning many different stocks, holding many different funds, all priced in the same currency, is still a form of concentrated risk. This is why large institutions, pension funds, sovereign reserve funds, long-term asset managers, always think in scenarios rather than forecasts. They do not ask, what is certain to happen? They ask, what if scenario A happens? What if scenario B happens? And what if things do not unfold as expected? Risk management, at its deepest level, is not about avoiding risk, but about not allowing a single risk to determine the entire outcome. For individuals, that begins with very simple questions. What percentage of my assets depends on a single monetary system? If purchasing power continues to erode slowly but steadily, will I notice in time? Am I measuring my wealth by numbers, or by my ability to maintain my quality of life? There is no single correct answer for everyone. There is no universal formula. But there is one common principle that has repeated itself many times throughout financial history. The most dangerous periods are not when a crisis explodes, but when everything appears to be fine, while the underlying structure has already begun to change. You do not need to get ahead of the crowd with extreme decisions, but you also should not be the last to realize that the context has changed. And to conclude this entire journey, we need to return to one simple principle, a principle that has helped many people navigate major transitions throughout financial history. Follow the money, not the headlines throughout financial history. Major turning points rarely appear as clear warnings. They do not arrive with sirens. They are not announced in advance on front pages. Most of the time, they unfold quietly, while headlines continue to reassure that everything is fine. That is why, during transitional phases of the monetary system, the most important thing is not to predict the future accurately, but to observe the behavior of capital flows. Money has no emotions. It is not loyal to slogans. It does not care about political debates. Money responds only to risk and imbalance. When you see large institutions diversifying reserves, reducing dependence on a single unit of measurement, preparing for multiple scenarios instead of a single narrative, it is not because they know what will happen tomorrow. It is because they understand a very basic truth. Financial systems do not change through sudden shocks, but through the gradual migration of trust. Trust in money. Trust in the ability to preserve purchasing power. Trust in the neutrality of structures we have long taken for granted. When that trust begins to fragment, there is no moment when a switch is flipped. There is only a sequence of small adjustments that, if unnoticed, are only recognized once the distance has grown too great. Therefore, the final message of this story is not fear, nor is it chasing a specific asset or trend. The message is awareness. Awareness that value does not always lie in rising numbers. Wealth is not only nominal profit, and financial security does not come from a single assumption in a world where money is no longer fully neutral. Clarity of mind is the greatest advantage, not to move faster than others, but to avoid being swept away when the context changes. If there is one single thing worth remembering after everything we have discussed, it is this: do not let headlines decide how you think. Let capital flows show you where the system is truly heading. And from there, make choices that fit your circumstances, your time horizon, and the life you want to protect. Don't forget to subscribe to the channel and watch the videos on this channel for their compelling content. I wish you a valuable lesson and that you choose a frugal way of spending and a truly profitable investment. Wishing you success.